Greetings, friends, on the Cryptosphere channel. The negative trends in the markets continue. I would not say that the cryptocurrency market is gaining something of its own, where traders are paying attention to some internal factors. Certainly, when markets are not feeling well, every ecosystem gets its fair share of pressures, and today is no exception. We got the dusty story on cryptocurrencies again. That's what we are going to break today. The role of this dusty story used to be the online service MTGOX, but now it is a thing of the bygone days. Now the outgoing Biden administration is starting to play a major role. Let's see if they dare to do what they were finally allowed to do. Today in the video we will break down all the market moves and touch on a couple more interesting news stories. Well, before we get to the news, number one, I am giving these two charts of the movements of the top of the S&P 500 and the Bitcoin at the bottom. Basically, with a few minor rough edges, we can see that global assets are going somewhere in their own direction. Unfortunately, that channel is a negative one. Plus, it is very clear that the main pressure yesterday both the S&P 500 and Bitcoin experienced at the same time. The intraday bottom was at the juncture of January 8 and 9. So at the time of recording this video, both of these assets are hurting equally. We'll see if the trend continues beyond that. We'll dig deeper into what happened. In the meantime, the negative news on Bitcoin has not kept us waiting. We get out of the dusty coffers of history, and we see that the U.S. government, while still in the person of Biden and Harris, received the right to liquidate 69,000 Bitcoins. It is $6.5 billion. Officials have confirmed this for sure. And this story is not a new one. I think the judge had already indicated even earlier that the U.S. government had the right to sell. But apparently, they had already completed the final legal paperwork, and so as of yesterday those Bitcoins are in limbo. Rightly, writes the person who made this post, that this is an interesting situation, less than 2 weeks before the new chief administrator of the United States, Trump, who has vowed not to sell a single Bitcoin. And this is the letdown. If we go now to the U.S. Treasury Vault, there are no sales as of today. The last move there was 2 weeks ago. Of course, it is a somewhat frantic time right now, and it is hard to tell if the outgoing administration is thinking that if they sell these Bitcoins, they'll be reminded of that when the new election comes around. It is like, what's the matter with you Democrats, because you tried to make the market so fucked up? And also, while it is still an open question, the repression of UST, as we know, there are hints that there is an investigation. But this topic has subsided and these 69,000 Bitcoins are in the foreground. Of course, it is clear that with many companies adopting a Bitcoin strategy, 69 is a very small fraction. The only effect they can have at the moment is psychological. But who will be left fooled is the big question. The ancients coined the saying that the road to hell is built by good intentions. It is these good intentions that can justify anything from war to the SEC chairman saying, "These are just good intentions, nothing more. We want to protect Americans, consumers first and foremost, and do not get me wrong." Yes, very good intentions, such as recognizing NIFT as a security, well, and a number of other questionable enforcement practices. Enforcement that we have seen in the history of Harry Gensler's tenure at the SEC courts, including some lost. But they had some wins. But the wins were mostly because suing the SEC is expensive, and it costs not $10 or $20 million. Anyway, this is the interview with Bloomberg, the down pilot. And the second point, the saga with the Democratic nominee is over. The new U.S. Senate Banking Committee refuses to consider a nominee who ignored the U.S. courts that told the SEC to approve and Bitcoin F. She voted against it, and still had the nerve to run for a second term in a warm seat. Now let her look for a job in some law office. I hope the top of the Democratic Party, because of her loyalty, will not leave her out of a job. They need people like that when they try to take revenge in 4 years. Oh, how the Federal Reserve did not want Trump elected, and remember, the first 50 basis point rate cut made a lot of noise, and now, basically, the consequence of that cut obviously, inflation in America is taking root. But you know who the Fed has to blame for American inflation. You will not believe it, Trump, for Fed officials are concerned about the impact of Trump's policies on inflation. That is, the Fed does not react even when inflation bites it in the ass, but is actively hostile to policies of a president with whom it disagrees, even if those policies have not yet taken effect at all. Bonds and stocks have sold off since the Fed's last meeting on Dec. 18, where it decided to cut rates, while oil and gold have even strengthened a bit. Bitcoin is not something we are taking on at the moment.
More remarkably, expectations of interest rate cuts fluctuated around the world, but returned to the lows recorded after the day of the Open Market Committee meeting, which consequently implies a 50% probability of 1 or 2 cuts in 2025. Yesterday we took the yield curve apart. It has steepened dramatically, and that's owning over the markets right now. We'll get into that later. In general, the market is much more hawkish about future Fed cuts, and here's just what was in those minutes. Key data include that many participants noted that a number of factors underscore the need for a cautious approach to monetary policy decisions in the coming quarters. Some participants said that keeping the target range for the federal funds rate unchanged made sense, and most participants noted that judgments about the appropriateness of policy action at this meeting were carefully balanced. Some noted that the disinflation process may have temporarily stalled, or noted the risk that it could, and that, as you can imagine, is Trump's fault, for Fed staff included the assumption of possible policy changes under new President Donald Trump, resulting in a slightly slower forecast for economic growth and inflation remaining stable. Almost all participants thought that the risks of higher inflation would increase under the new president. Well, the minutes indicate that a number of policymakers indicated that they also included an assumption in their updated economic forecasts due to a change in the political structure of the United States. What is interesting is that prior to the release of these minutes, the markets experienced increased volatility. We saw an intraday bottom, and after the publication of these minutes, the markets calmed down a bit. But there is still downward pressure. But a number of other factors intervene. In addition to these reports, the markets are already preparing for the labor force data that will be released tomorrow. I'll highlight a few interesting points from the traditional market. I mentioned yesterday separately as well. The video focused on the block about rates remaining in focus in the new year, as 10-year bond yields have risen as much as 60 basis points since early December. Let me remind you that stocks usually struggle. We talked about this yesterday when rates rise by 2 standard deviations in a month, which is exactly 60 basis points in today's environment, and given the increased focus on higher yields, baskets of technology stocks from the shortest position are experiencing, attention, their worst day ever. The trading desk at Goldman Sachs Bank notes that they are seeing significant supply on their floor across the board, with the technology companies most often shorted below their 50-day moving average, although it probably could have been worse as, for example, today's trendy quantum computer stocks were wiped out after Nvidia's CEO warned about the timing of quantum computing. Despite this volatility, the bottom line for the day was this: small-cap stocks suffered the biggest losses, while large-cap companies ended trading close to lossless. Crude oil prices posted their biggest drop in a month, and that came after rising for 6 of the last 7 days. Gold, the main beneficiary of all this, rose despite the strength of the dollar, testing the 2,670-point mark.
Well, here just ahead is the daily movement of the dollar index. Although it ended the day in the plus side after a sharp rise on the 8th, we see a slight downward movement after this sharp jump. Well, I guess I'll also note lastly that Bitcoin ETFs had some of the worst results, just barely missing the record withdrawal, almost $600 million in losses. For Ethereum ETFs, I would not say that the situation is better for this particular instrument, but I would also probably point out that Fidelity was a great buy at the beginning of January, and now it is a great sell, both for Bitcoin and Ethereum ETFs. While you cannot see the BlackRock data here, it is just not included. Well, of course, friends, I recommend subscribing to the channel where you'll find tons of additional information on both cryptocurrency and the traditional market. And that's all. You were with you channel Cryptosphere. Subscribe. If for some reason you are not subscribed yet, click on the bell to not miss new videos, because next will be even more interesting. Bye bye.